Welcome to Living Your Greatness. Each episode, we bring on great people to inspire you to achieve your greatness. We discuss topics all related to health and wellness. Listen to world-class stories, learn valuable lessons, and turn knowledge into action. It is now time for you to unlock your inner greatness. Welcome back to another episode of Living Your Greatness. This is your host, Ben Mummy, and today we have a new guest to the show, and his name is Tavi Costa. For those of you that don't know Tavi, he is the portfolio manager at Crescat Capital and has been with them now for 6 years. Tavi has built Crescat's macro model that identifies the current stage of the US economic cycle through a combination of 16 factors. Tavi's research has been featured in financial publications such as Bloomberg, the Wall Street Journal, CNN, Financial Post, the Globe and Mail, Real Vision, and many more. Before joining Crescat, he worked with the underwriting of financial products and international business at Braservice, a large logistics company in Brazil. So Tavi also holds a Bachelor of Business Administration that he completed at Lindenwood University. So Tavi, welcome to the show. It's great to have you on today.
Thanks, Ben, for having me. Looking forward to this.
So Tavi, tell us a little bit about yourself. Where did you spend your formative years growing up? What led you to a career as a portfolio manager? And what motivates you the most about your profession?
Well, I grew up always in a business environment. My parents grew up in Brazil, first of all. I was, since I was in young ages, my parents always had their own businesses, which was mostly in the retail side of the industry, and I always helped in very different levels, from selling things, especially, to organizing things and cleaning things, and trying to attract people to the store, helping them to manage the whole thing. So I basically grew up on helping them with their own businesses, and later on in life, things kind of took a turn to the downside, actually. And I kind of saw the difficulties of having financial problems at a 14, 15-year-old age, which is not fun when you're obviously getting into high school and starting thinking about college and all these plans, and you're running out of money. So we went from a sort of an emerging rich family in Brazil to a very basically a low class environment. And so going through that at that age, I think, was very helpful to value growth professionally, and also look for avenues to find out if there is a better life, especially professionally. And I used tennis as my avenue, and moved to the US through being recruited to play tennis at a Division I school. I played tennis there for a bit in Liberty University, and I moved to another school where I could focus more, especially in my studies, and instead of being an athlete. I think that helped quite a lot, knowing that I wasn't going to be a professional athlete or anything like that. And so I think that helped me to refocus and start a whole new process of learning, especially finance. I really fell in love with finance. I was already in love with business in general, and I would read as many newspapers as you could every day, and really learn all the terms and learn all the different ideas, and realize that there's not a single answer for anything. It's a probability game at the end of the day. Then after college, I found my way into the hedge fund world, and I've been very fortunate to build a lot of different things at Crescat, starting really from zero, where we've always had a very value approach, principled sort of investment management firm, and that kind of grew along to really build other macro related models to help the company to succeed and develop different themes to invest. And I think that was really my biggest role in the company at the time, really coming up with a narrative and different ways to to implement the models that we had currently and apply them into this business model idea of different cycles that we've had in different parts of the world. Then later on, obviously, with sharing some of our research, I started to really be able to share a lot of what we do in terms of analysis with the different media outlets. I think that was really what grew me to become where I am today, helping the company to raise money as a whole, but also, most importantly, implement the best way we can. So in 2018, 2019, we shifted the business, given our views about commodities and precious metals, especially, to really build a whole new fund solely focused on funding exploration and development stories in this mining industry, given our views. And I think that has been a huge turn. It's been a great successful strategy so far, which was launched in August of 2020, right after this issues that we had in the pandemic crash. And our views were that commodities are going to lead the way to the upside, given the level and size of intervention we're seeing from the governments worldwide. And so that hasn't changed. We still think that we're still early in what we could call a super cycle for commodities, even though it's sort of a well-known term for this. I believe that precious metals is really where we believe there's a lot more value to be built. And this lack of especially discoveries of commodities as a whole, and companies and funds really deploying capital into replenishing those reserves of the majors. So I think that has been sort of our focus recently, which is very much aligned with the macro views that we have. So that's kind of how I found myself into this industry from the very early bottom, from my young childhood times to all the way to here, being a portfolio manager at Crescat.
Thanks a lot, Tavi. I appreciate you expanding on kind of your background there. Moving to my next question, you recently published a research article called A Tale of Two Destructive Outcomes. Could you please share with our listeners what this article was about? Why should we pay close attention? And lastly, what are some key takeaways that we should take note of?
Well, look, there's a lot of things to think about in this research piece that I and Kevin wrote. Our goal really was to dig a little deeper on the potential impact of the deflationary and the inflationary possible scenarios, especially for a precious metals and commodity investor. And in a way, it's kind of a case for gold and silver and commodities, but from a perspective of looking at the options that really the Federal Reserve has in the following years. And in my opinion, as I've said before, they're really trapped or cornered into two choices, and they're both very destructive outcomes. One of it is continue to print money or expand their monetary base and the balance sheet assets in order to suppress interest rates and creating, I would say, a very inflationary environment. The second one is the deflationary route, which has a lot to do with having to reverse this really extreme monetary policy that we're seeing due to overheated economic conditions. And with that, we may see a reckoning moment, especially for assets that are extremely overvalued. You name it, from equity markets to corporate bonds to even sovereign bonds, and you can have housing market having issues if interest rates go higher. So you have to be able to weigh what is the highest probability of something happening between those two routes. I believe that, given the fact of what happened in the last two recessions and how monetary policies and intervention by governments from the fiscal and monetary side have progressively become larger, I believe strongly that they're going to take the inflationary route, and they have been already. Can they reverse it with the tapered language and the tightening language becoming actually effective soon? Sure. I don't think that's going to be the route they're going to take, though. But I respect the deflationary, especially the deflationary thesis as a whole, which in a way, it really comes down to one thing. I mean, you can talk about the aging demographics. You can talk about the positive deflationary technological advancements we had. You can talk about the secular decline as well in wages and salaries. But it really comes down to the secular decline in money velocity. And I think most investors have done very well discussing this as a large factor that really feeds into this deflationary thesis. But when we look at places like Japan that went through situations like that, did it really matter for gold investors? Gold actually went up threefold since 2000 or so, over threefold, almost fourfold, while money velocity in Japan was falling apart. Well, let me use another example, Turkey or Brazil, where both of those countries' money velocity measurements actually had a very steep decline over the last decades, and still both of them have actually experienced very large issues with inflation. So it's one factor to be really aware of. However, I think it's any well-formed macro opinion out there, you really have to consider other factors to be successful. And I agree that using Turkey or Brazil to be an example for this is probably not as appropriate given the size of the economy and the level of dollar-denominated debt or other issues such as the U.S. being a reserve currency, for instance. It's not a benefit that all other countries really have. And so when I consider this vast list of inflationary factors causing, my opinion, this higher probability of that route happening through especially the Federal Reserve decisions, I think it's a much more important factor, and especially the fact that money velocity, especially looking at the rate of change of that, has actually been turning positive recently. So that is very early to say that we have reached the bottom, but it is important to note that money velocity year-over-year change has been going up for the last 3 months, and so, or at least decelerating the downside decline that we've had in the last year, or especially the last decades, but really steep decline that we saw recently. So I am on the other side of that trade. I believe inflation may actually be triggered in a more long-lasting impacts of that. And I'm very focused on that. And I think it's a little bit more positive for precious metals and commodities, especially the cyclical ones. However, does it really matter for gold and silver investors if we do have a deflationary environment, such as a declining money velocity because of the very large amount of money supply being created and expanding through different avenues that we see? No, I think that doesn't really matter, and that's the greatest investments are those that really can perform well during those opposing circumstances in the economy, and so that just gives me the higher conviction to continue to do what we're doing, which is going up on the risk curve and looking for the most levered and asymmetric bets we can make, not on the debt side, on the point of being levered, but to the leverage of silver and gold prices. And so this has really been the focus, and I really wanted to break down the reasons why we feel so confident in this precious metals and commodities thesis.
Okay, great. Do you think the Federal Reserve Bank is trapped when it comes to dealing with inflation and debt? How do the central banks resolve this issue in terms of monetary policy?
Well, it's difficult because clearly we have a very large, I think Treasury market really holds the key for the entire financial system today. And in my opinion, having to suppress rates have become the primary mandate of the Federal Reserve, even though it doesn't discuss that in any of their statements and the reports. But I think that shows the level of dependency that financial markets and the economy have on suppressing rates, and why I believe it's going to be very difficult to see meaningful tapering or tightening in the following years. The perfect analogy that I like to use to their direct message that we saw recently is they're thinking about starting a diet 2 years from now. And so I believe that, the complacency towards especially policies to create inflation again and not actually having long-lasting effects into triggering a long-term inflationary cycle like we saw in the 1910s and 1970s has become one of the biggest things for going for gold and silver and commodities, and this need for given the policies that we're seeing, the need from investors to protect capital and seek especially tangible assets, given the fact there's not really any yield to be found in any investment out there, from equity markets, corporate bonds, everything yields less than inflation expectation, is really forcing folks to hoard tangible assets. And so we're seeing this this impact in capital flows, especially in commodities. So I think that it's going to be difficult. The only way out of this would be if we do see some sort of real organic growth in the economy that really allows the Federal Reserve to reduce its purchases of treasuries and mortgage-backed securities and ZIRP or NIRP, which is near zero policies of rates. If that's the case, where it really allows them to completely remove themselves from this really big role that they're playing into manipulating the markets as a whole. I mean, look at Treasury yields; it shouldn't be where they are if it wasn't from all the the Federal Reserve owning 25% of the Treasury outstanding today. So I think that that's really the only scenario that would be the very positive one, and I think it's going to be very difficult to see that. So that's why I believe in the two very they taking one of the least worst outcomes of either the inflationary or the deflationary one, and I think they will continue to take the inflationary until things get really overheated, and at some point, they're going to have to take the deflationary one. So that's why what lives right in between those two outcomes is the commodities to equity ratio idea. And that's why I like to own a lot of commodities, especially precious metals, but also have some hedges on the downside.
So this leads me to my next question. Is there good public awareness about inflation and labor pressures among the general public? Does this affect investing sentiment?
I think it's a starting. It's certainly not as prevalent as you saw back in the 70s or other times or in places like emerging markets, but it's definitely a different type of mechanism than we see in other parts of the market. Usually, when you hear a lot of folks talking about something, we're about to see the opposite. But with inflation, it's a little bit different because it feeds on itself and it creates consequences of on a level of decision making from businesses and households of either hoarding different things than cash, spending cash, not holding actual dollars and looking for different alternatives. It drives investors into other ideas such as crypto markets, lumber, housing markets. And so this is sort of what we're seeing right now. The savings rate, which I know a lot of people are thinking immediately about that when I said people will not be hoarding cash, it just means there's a lot of cash in the sidelines and a lot of room for growth in tangible assets, given the balance of what we're seeing in terms of that. And so I think, there's a lot of reasons to believe this is just the beginning. And we're not seeing, you walk on the streets today, you talk to people. I think people are starting to realize that prices are starting to rise. And when you use a case study of the 1919 Spanish flu, for instance, we did have inflation becoming a problem, much bigger problem than a single digit increase in CPI numbers, which is largely understated from what's really occurring in the economy today. But it led to another thing, which was cost of living began to rise and really caused folks in general to to really try to pressure their employers to pay higher wages and salaries. I think we're at the beginning of that trend. And that has been one of the most important factors in the last 30 years that we didn't see meaningful inflation in the system. And I think as we change that and we start seeing not only the government giving money to the people through helicopter money policies, or really what I call the largest transfer of wealth from the government to the people we've seen in history, where the government is largely indebted, but also gave money to the population, especially, well, sure, the entire parts of the society, but also in a very meaningful way, the bottom 50% also really had a very beneficial period of time recently with the large increase of net worth of those folks. One, given the fact that they make money on housing and they own a very large percentage of their assets in real estate, about 40%. But also, most of those policies were actually directly given to the bottom 50%. And I'm referring to stimulus checks and so forth. And so I think all of that put together is we're about to see, well, we're seeing the labor shortage problem that is also creating a need for employers to increase wages and salaries to attract folks to come back to the labor market. So all that together, I think we're just at the beginning of those developments. And I think we're going to see a lot more of that. And I think the next step is going to be wages and salaries. And people are going to be talking a little bit about either through protests on the streets of focus, really folks demanding higher wages and salaries, or just an action from executives to take those policies going forward.
Do we currently have a bubble in the equity and housing markets? How does it compare with the previous bubbles?
I believe we do. I mean, looking at across 15 to 16 factors of valuations through aggregate basis or just median and average calculations, you find very quickly that we are in a very overvalued market, and it is a bubble, especially because there's a lot of misconceptions about what companies will likely be doing in the following years, especially with the environment that we have macro-wise in the last decade of being very positive deflationary. And I think it's about to change. I don't think we're going to see a positive deflationary. I think if anything, on a decline of consumer prices index would be a negative deflationary environment instead this time around. And so those changes, and again, I weight a higher probability of inflation, those changes will also change the leadership in the equity markets. And the leadership has been done mostly through growth stocks that are incredibly overvalued. And so if you look at the natural resource industries, which I think is where the value really is today, those are the ones that look very cheap still, from oil stocks to mostly, in my opinion, gold and silver stocks and base metal related stocks and so forth. And so I think that's where this rotation is happening currently. But I do believe we are in a bubble for that. Housing market is tough because at the same time, I do believe there are regional problems in different places. There's also an agenda here politically, from especially the green agenda, but most importantly, the inequality agenda. It's important to understand that government is always looking for reasons to spend money, especially. And so reasons to have large deficits. And those are the two biggest narratives today happening in the government. And the inequality one is important to think about because, as I said, the bottom 50% of the population owns a lot of real estate. So it's almost like a national order to suppress mortgage rates through the purchase of mortgage-backed securities or anything else that they can do in order to really accomplish the same idea, in order to also continue to prop up housing prices. So I'm not betting against that. This is not where I am. I'm betting against growth stocks, especially in the high, especially tech names. But I think we certainly are in a bubble, especially, sovereign bonds are in the same position. But at the same time, I don't think I want to fight against this such a priority for the government as a whole, especially from a spending perspective. So I think both are a bubble, but housing is more regional. But that would be my best way to answer those questions.
Okay, great. Thanks for those explanations. So Tavi, I have read from your work that you strongly believe that a gold and silver supply cliff is happening. Do we have a supply crisis coming in the near future?
I think so. Well, look, just looking at the depletion of reserves from the majors, it's clear to us that they're going to be looking for forms of replenishing those production pipelines. And the level of discoveries we saw in the last few years had been dismal. And really, we saw zero gold discoveries, large gold discoveries, new discoveries in the last 3 years or 4 years. And the same goes for silver and copper as well. It's been very difficult to find. The geological challenges of finding those have been increasing as well. And the amount of spending in infrastructure developments, especially in the exploration side, has been in a declining trend, regardless of how some metal prices have been rising. And so it's the first time we see this reluctance to spend money at the same time as those companies should be doing that. And they've done that in the past as they become more optimistic. But that is because we went through a long years of a lack of investments, and also long years of capital bleeding into this industry, where it created a lot of skepticism from investors demanding better fundamentals from a profitability perspective, but also margins and perhaps reduced spending. So we're seeing all of that today. Those are all signs of being at the early innings of a bull market. And so investors, and especially I would say large producers with consistent free cash flow, are not looking to expand their exploration projects at the moment. And some of them don't even have much of that. And so as a fund, we're trying to work towards being the ones that provide those projects to those majors. But I think we're going to have an issue where the green agenda is being pushed with such a high priority today that a lot of people are not seeing the other side of it, which is, for you to go from the old to the new economy, you really need commodities. It's your highway from the old to the new economy. And that highway, it's getting more and more expensive. And the lack of investments in space, which a lot of people are seeing as transitory, has no transitory impacts whatsoever. It's actually very much of a permanent issue, where it's tough to find labor. It's tough to find especially drilling, drills or any equipment for exploration is becoming very difficult to find. And so the capital, in order to raise capital for those companies, is still very difficult. And so look at the capital structure of those businesses. They don't even take debt anymore. Why? Because the investors don't like that. Now look at other markets. It's okay to take debt. So those are all signs of a industry that has been into what I call really a depression, and still coming out of that. And as commodity prices rise and create this place where investors start to see the opportunity and begin to put money into those businesses, we may see a bubble too. And so it's okay to be early in a bubble. It's not okay to be invested in late stages of a bubble. We're not in a bubble in natural resources, by the way, but I think we're probably going to inflate one in the following years. And that's going to be, there's a demand side that comes from the macro imbalances, but also the supply issues are just as compelling, in my opinion.
Okay, great. So this leads me to my next question. Are gold and silver currently undervalued? What about the miners? Can you please explain?
Gold and silver are incredibly undervalued relative to money velocity, money supply, to monetary base, to equity markets. to any other asset class, really, and the under allocation of especially large capital allocators. I think that's, given the where gold and silver, and I think things get lost, is the idea that gold and silver perform well, especially in inflationary environments, and it does. But where it really performs well is at times when you have this monetary and fiscal disorder and the increase of debt in the system, and that's precisely what we're seeing today. So I think those are all signs of being also at the early innings of a precious metals bull market, on top of having this supply problem that I believe strongly will hit the market in the following years. And as you become constructive in that trade, you obviously start to go up in the risk curve, and a lot of folks begin to buy the top miners. And it's the first time in 73% of the miners today are profitable on a free cash flow basis. Still, we have Apple being 3 times the size of the entire mining industry, precious metals mining industry. So asymmetry to this trade, and how early we are still, is what attracts me. I haven't been to a network event yet to hear people telling me that they're buying properties to look for gold and silver. The only question I get is if I'm a day trader or if I like crypto assets. And it's, when I hear that, I think that the sentiment is here, but we're so far away from that. And so I think that on a free cash flow basis as well, we're going into probably the sixth quarter in a row where especially the top 50 miners are reporting positive free cash flow on a median basis. We've never seen this throughout the history of this industry. They've always lost money. They always spend more than what they made. And so those are all important changes. And the balance sheets are improving. And I think that in the next few years, we're going to see a rush towards those industries. And I think precious metals will do very well in this environment too. But it's going to be clear to me that it's a lot of value with a lot of embedded growth and currently oversold, technically speaking. So I think there's a lot of reasons to own those assets. And as I said, capital allocators don't own any of those at all, actually. And so the need for protection will lead to a large appreciation of those assets, in my opinion, in the following years. So I think they're very undervalued.
So Tavi, you've spoken a lot about the future of precious metals and this whole super cycle. But what would happen to precious metals and miners in a stock market crash?
Oh, look, I think there's a lot of investors fighting the last war, looking at what happened in 2020 and 2008 when miners fell apart along with the equity markets. I actually happen to be, again, it's all a probability game, but if you look at 3 important times in history, the Great Depression, which was a deflationary bust, the 1973-74 crash, which was an inflationary bust in the 70s, and the 2000 tech bubble when he burst as well was more of a deflationary burst, but also I would say from highly speculative environment of the tech sector as a whole in the markets. But when you look at those 3, you see a clear divergence between the miners and the equity markets. And this is mostly due to what happened with either confiscation of gold and silver back in the days, where caused investors to buy the miners, or just an inflationary crash where even though there was a deflationary bust going on with the decline of asset prices in 1973-74, the environment was still highly inflationary, what caused folks to buy miners. And so we saw that divergence. And again, we saw in this highly speculative environment recently in the tech bubble, where investors actually bought miners, given what the Federal Reserve and other policymakers were pursuing as at the time in order to fix the problem. And so a lot of reasons to believe that we may see the divergence of those 2 markets, where miners actually receive a large appreciation of relative to the equity markets, and also given the level of intervention that we saw since the March crash or the pandemic issues that we saw back in starting in February and then March was the real involvement from the Federal Reserve, and by showing that we're here to support the equity markets with a lot of money printing. And so I think that can lead to a lot of investors thinking that immediate decline in 20-30% in equity markets would also lead to a lot of even further expansion of the monetary base. And I think that would drive this divergence between the two. Markets are smart, and usually what happened in the last war may not happen in the following years. And I love the fact that everybody's looking at the last two incidents of crashes, thinking it's going to play out exactly the same. So I like those setups, and I think there's a very high probability that we may see a divergence. Again, if it doesn't happen, we have equity shorts, we'll be fine. But I think that there's a chance, the high probability that actually the divergence of the two may occur.
Could you help us understand the silver to money supply M2 ratio chart on your website? What is it telling us? Could the ratio change anytime soon?
It could. If M2 declines, it could change, or if M2 increases, it could change as well. And also with the price of silver, those are the three variables, obviously. But what I see in that is a technical and macro thesis behind silver, where obviously I'm a big believer that the supply constraints, which are not reflected in that chart, will play a big role into especially impacting prices higher. But when you look at that chart clearly, it shows the level of monetary disorder we saw in the last years, and in the level of increasing in money in M2 money supply. And so I think it's silver and all those metals. It's difficult to find intrinsic value of that. And it's important to look back and see, well, look, those are alternatives of the monetary system in the past, and therefore they should be seen as comparisons to what we have currently. So when you have such a large increase in monetary base and money supply, you have to compare that with metals that were used as part of the monetary system. And silver certainly was one, and a highly leveraged one compared to gold. Highly levered, and I mean that given how silver is much more volatile relative to gold. In my opinion, technically, we have a double bottom in that chart as well of gold relative to money supply. I think we had it much higher. We saw a big move recently, and I'm talking about the last 1 to 2 years, and then the last, I would say 7-8 months, we saw a consolidation period. So for a lot of folks losing faith in this trade, I think it's an investment that will do very well in the following years, and we needed a consolidation time to really reduce the weak hands, as we like to say, and have the smart money buying into the story. So I think we're going to see prices go well above the prior highs. I think there's a reason why silver is really hugging this $26 an ounce price, and that's mostly on the quarterly basis. If you look at those charts, clearly it is a very important level. If we break from there, I think there's going to be very little support to go up to 35 or so. And again, I'm talking about quarterly charts, not daily charts. We haven't seen a close above 26 in a while. And once we do, I think we're headed much higher here, technically speaking. So I'm very focused in all parts of fundamental, macro, and technical, but obviously I weight much higher probability on the macro side, and that's why I like those assets. And silver, for me, is the cheapest metal on earth today.
Okay, great. Are gold and silver capable of reaching new highs in the near future?
I think so. I think we're going to see new highs in the next potentially the next 3 years or so. Again, I don't need to be right on this, but if it's up, I'll make money. But I think we're going to see new highs in those two assets. Yes.
There has been a lot of attention on silver this year, so much that investors were trying to squeeze the silver price this past January and February. Why is silver the best investment for the next 12 months? And what is your single most compelling argument to invest in silver stocks?
Well, I think there has been a lot of attention, and that's important. This increase of people talking about becoming a more prevalent narrative is all part of the what creates this demand. But I would say the macro imbalances is probably it's tough for me to weight what's higher than macro or the supply issues. It became very popular to talk about supply because of the issues we're seeing recently with supply constraints that came from especially what we saw with problems with the pandemic and logistics issues that we're seeing worldwide. But I have a feeling that the macro is even more important. And there's something that a lot of people talk about is the deglobalization impact on inflation that may create an important factor for especially gold and silver prices. And I think there's a reason to believe that we may be entering an inflationary environment just because of that. Especially U.S. and China relations have been, we're seeing a lot of issues and signs that things are not improving at all. They're actually getting worse. And those, as we all know, China is the manufacturing plant for the world. So I think there's reasons to believe that those issues may impact inflationary forces higher. But you asked me for a single one. I don't know if I have the answer for that because I weight a lot of things. I don't like to rely on one sole factor. But if I had to, I would say the macro imbalances and this monetary and fiscal disorder is what leads to the hoarding of tangible assets in the future. So I think those are the most important parts of the market right now.
Okay, great. What indicators and data will make you change your views on the silver price evolution?
I think if we see a real organic growth, as I said before, I think that would change my opinion. If there's no monetary and fiscal disorder, then there's no need for money printing. There's no need for helicopter money policies. The economy is growing on its own. And so I don't think that's going to happen. I think that's going to be, we're going to see the opposite of that. We're going to be seeing the continuation of those policies in the future that may continue to create problems. And so if we see the other way around where growth is I would say economic units are growing faster than debt units, I think I'm going to change my opinion. We saw $114 billion of real growth in economy since January 2020. And at the same time, we saw 43 times that amount in debt growth since then. So I think we're going to see the continuation of that in the future here.
Okay, and Tavi, what are your thoughts on Basel III and its possible impact on prices of physical gold and silver?
Look, I don't have a lot of views on that, and that's mostly because I don't believe much on the conspiracy thoughts about gold and silver. Actually, I'm not I think that there's other factors that are more important to consider here, and so I'm not I believe that there's they may a lot of that is priced in. I don't think that people that are worried about the paper market and may lead to lower gold and silver prices in the future. I wouldn't be too worried about that. I think there's, we're seeing macro drivers to die for in this environment. And I'm a big believer that's going to continue to be the case.
All right. Who are your greatest mentors? Where do you suggest that millennial investors go to better educate themselves before making any investment decisions?
My greatest mentors, that's a good question. Well, I think my partner has been a really good mentor. Kevin has taught me a lot about how to deal with the markets as a whole. I mean, obviously, I also added a lot on the macro side, but I would say on the value principle side, I was very well coached by him as a whole, and that really helped me to have value principles to rely on in tough parts of the market. And having principles is very very key to build a reputable, especially track record in a very competitive world of hedge funds. And so I appreciated him helping me and coaching me throughout the years. Obviously, my parents have been very supportive of everything I do. Not much on the financial world of especially analytical and management side, but I speak with my parents every day still, and I think it's very important for me to have that as a way of a support of mentally, and having family close is really important. So my dad went through a lot of things, ups and downs, and seeing things from his perspective, I think helps me to see the other side and the light at the end of the tunnel in a lot of things in life. And so I use him as a mentor as well, I should say.
Absolutely. Thanks for sharing those individuals. Which commodities are you most bullish on for the next year? What is the best way for retail investors to punt this play?
It's for me, it's silver. Silver is also undervalued relative to other metals, other commodities as well. I mean, you can see a divergence between silver prices and commodities index equal weighted. You can see the gold to silver ratio. You name it, everything looks cheap relative to silver from the equity markets, monetary base, money supply. You do any ratios, you see there's clearly a problem where you immediately think that silver is incredibly cheap. The best way to really position yourself, in my opinion, again, I continue to think it's on the minor side, meaning you want to buy silver in the ground. Mostly, that's the most profitable way, or the most levered way to silver prices, but also riskier. So I like to have a very diversified portfolio of a lot of projects that can do well in any environment of lower, let's say if silver goes down 50% in prices, a lot of the projects we own would still be profitable and very desirable by a lot of the majors. And so we like to look at those as part of the risk management, but looking for high grade and profitable projects and economically viable is key. And if investors are looking for names, I suggest you to look at the YouTube videos that we put out every week, and we describe the thesis behind each of the names that we get involved. We have about 70 to 80 names in the portfolio today, but we really shared at least 35 or so in publicly. So there's enough information about what we're getting involved with. And I think those are the best ways to, obviously I'm biased because I've long all of those names, but if you ask me what I'm doing, that's what I'm doing. And I think that's doable in any level of whatever you are in terms of your financial class or situation.
Okay. And what are your top stock pick recommendations for 2021?
I would say it's SK Mining is the number one. It's in British Columbia. They have, as we all know, it's used to be. I'll just elaborate on this one a little more because it's my favorite one. The other ones I'll just give the name. But this one is especially the case because it was SK Creek Mine. It was a company maker for Barrick. Everybody knows Barrick very well, and it's owned now by the project. SK Creek is now owned by by Skeena, which is north of or SK Mining is south of this SK Creek project, and SK Mining's property really is about 500 or so square kilometers of size, and we think we have multiple SK Creeks in that company. So if we think that's could potentially be a multi-bagger type of opportunity in a very safe jurisdiction, real high grade discoveries. And we have several targets that we're really excited about. And again, those are small cap companies, very, very small, but we're really excited about this one. I think it's one way of buying property that has a lot of gold and silver in the ground potentially. And I think there's a lot of high probability that we're going to hit those. The second one will be Firefox. I think Firefox in Finland. Firefox Gold is the name. Is going to be worth, it's going to be also a multi-bagger in the following years. It's onto a very similar project than we have in Newfound Gold and what we saw with Foster View, Swarm Zone extension of their project there. I think it's a very similar geology, and we like the team, and I think they're going to deliver. And the third one is New Legacy in Nevada. And I think that one is another one that is onto a very, very large system. It's a gold system. We call it the post-Betsy deposit. And we think it's prudent for investors to be allocated to those three names. We have a very large position in those, and we're very large shareholders of those companies as well. So, and we have a large involvement from every level in those companies from an activist standpoint. So we like those businesses, and we think they're headed way higher than where they are today. So that's a very important opportunity, I would say.
Thank you, Tavi, for sharing those recommendations. As you know, Tavi, the purpose of this podcast is to inspire people to achieve greatness and enhance their personal well-being. What is your definition of greatness?
Well, my definition of greatness, that's a very good question, but I think it comes down to being grounded to other principles in life and driving your goals through a lot of passion, which you can describe or pretend to have passion on anything, being consistent and having being respectful as a whole of in that process as you pursue that. And so I try to relentlessly look for those ways of implementing my goals the best way as I can, regardless if it is through diets or exercise or just ways of investing. But I'm definitely very focused on my goals. I have a lot of goals in life. This is doing well in the gold space and silver space and delivering for clients is certainly a priority and one of my important goals. But I have other goals in terms of my mental health and physical strength. And I think that's what it's about. It's not only about making money, but it's about growing as an individual, having very close relationships with people you love, regardless if it's family or friends. And I try to diversify my time into all those. And I think those become really important charging or recharging times for me to then do as best as I can in this industry of hedge funds. So I'm very focused in this in doing well, not only financially but also with my family and friends. And I think it's important to have this very diversified way of looking at life. I'm also very religious too, and I think that helps me to be grounded into my principles and to do well in general.
Awesome, great. Thanks for sharing that perspective, Tavi. Well said. So Tavi, where can our listeners go to connect with you online?
I'd say it's very easy. On Twitter, if you just type my handle is @Tavi Costa, or if you just type my name on YouTube, you find some of our videos, or Crescat on YouTube. You also find those videos. LinkedIn, I'm very active on LinkedIn, and now Instagram as well. I've been experimenting with an account there where I shared some of my views there. And so, I think those are all places where you can communicate with us. Website, Crescat.net. There's a contact place where you can communicate with us as well if you're interested in, and where you can find a lot of our letters and research as well, along with interviews that we've done in the last days and months.
Okay, great. Tavi, I will be sure to add all that in the podcast notes. And more importantly, I want to really take the time right now to thank you for being here. Thank you for being very generous with your time and answering all those questions for our listeners.
Sure, it's my pleasure to be here. Thanks for inviting me. It was great questions, very well elaborated, and I appreciated being here, and hopefully helped some of your listeners too.
This podcast is for informational purposes only and is not to be considered personal, legal, or investment advice or a recommendation to buy or sell securities or any other product. It is based on opinions, current events, press releases, and interviews, but is not infallible. It may contain errors, and Living Your Greatness offers no inferred or explicit warranty as to the accuracy of the information presented. If personal advice is needed, consult a qualified legal, tax, or investment professional.
Do not base any investment decision on the information contained on Living Your Greatness or our videos. Thank you for listening to the Living Your Greatness podcast. If this show has added value, please subscribe, leave a rating, and make a review.